one is the equity financing. This is the type of financing that come from your savings, families, and friends. Assets can be part of it as well. These are your investors who has a special relationship with you, but they do expect to make a profit when the business becomes successful. The relationship is less stressful, but it demands the same nonetheless. Equity financing, it will involve bringing in investors who, in exchange, will require for a share of ownerships of the businesses, and this sometimes can be written or unwritten. The advantage of equity financing, when it involves families and friends, it relies largely on trust. Investors can take a long-term view, and most do not expect a return on their investment immediately. That's a good thing for small businesses. There's no requirement to pay back the investment if the businesses fail. But of course, if you borrow money from your family and friends, the relationship can turn sour when you're not able to pay back your loan. But there is no pressure there, because it's a family thing. Of course, equity financing is less risky than debt financings, and you will have more cash on hand for expanding the businesses, because the requirement to pay back your loan is basically depends on how much you make every month. And the disadvantages, some of it includes it takes time to find the right kind of investors for your company. You really need to carve out a good business proposals to get these potential investors to invest in your businesses. In addition to that, because the ownership of the businesses, your equity financier owns a little bit of shares in your businesses. So some of the business activities will need to go through these individuals, because they need to approve the amount of money that you want to invest or you want to put in any particular activities. So that limits the power that you hold upon your businesses. In preparation of financial planning, it involves at least 3 items. Number 1, the income statement. Number 2, the cash flow. And number 3, the balance sheets. Now, how it started? Well, basically in the old days, it's just a matter of taking notes, taking down how much you spend versus how much you make every single day. Now, an income statement involve determining how much you make based on and how much you spend, your expenditures. And 5 items that made up an income statement includes your sales, your labor costs, your factory overhead costs, selling and administrative expenses, and production budget. And in pro forma of cash flows, it involves schedules of payments for your manufacturing costs, your capital expenditures budget, and schedule of collections from sales. While the balance sheets involve pro forma balance sheets, which estimates the financial conditions at the end of the budget period, and it starts with an estimate of the ending balance for retained earnings. So an income statement will look like this. You will have your sales, and then you will have your expenses, and then minus all the tax, then you will have your net income, which will be the statement of the income that you make every month. And then you have your cash flows from operations activities. You will have your net income, and then from that you will minus the changes in assets and liabilities, which involve items such as account receivable, how much money you make from your accounts, and then minus the inventory that you have to pay, because inventory itself are costs. The amount of inventory that you have to store to meet the projected demand for next month is cost, because you still have to pay for the warehouses, the utilities. That will become the cost, plus the prepaid expenses and account payable. They will form what is termed as net cash from the operations. Eventually, the data that you got from your cash flows and income statement will form your balance sheets data, where in the balance sheets data you will have your total assets, total liabilities, owner's equities, total funds provided, and the total funds expended. Then you will have what we call the net increase in working capital. Now, there are several institutions out there that support small businesses, but to choose the right one, you need to really select the right kind of institutions, because it differs in terms of offerings and regulations. The 5 C's that you need to do in terms of selecting the right financial institutions, as well as the 5 C's that the financial institutions use to evaluate the potential small businesses. Now, number 1 is characters. Financial institutions assess the characters of the small business owners, especially in cases where the borrower is a first-time borrower. They need to identify to know that these potential borrowers have the means, have the characters that it takes to last in the ever demanding business world. And then capacity, which is the capacity of the small business owners to enter into the contracts of borrowing the loans, maybe in the case of age and legal immunities. Number 3 is collateral. Now, any financial institutions would demand collateral for every cent, every dollars that they lend out. Sometimes your business proposal can be a good collateral itself if it's built so well that business proposal itself can convince and becomes a collateral to the financial institution. But some other time, most of other times, collateral can be in the form of other assets or individuals who can guarantee that the small business owners able to pay back the loan that they made. Commitment includes lifestyle choices and the types of loans that the business owners have currently, and it goes down to the extent of family relationships. And the 5th C is the circumstances, which includes markets, consumer trends, economic predictions, as well as environmental considerations. All this will form the 5 C's that the financial institutions use to evaluate potential small businesses in terms of lending loans to them. Now, some of the business institutions out there, or financial institutions out there, includes the Cone, Mara, PUNB, and other sorts of business funds such as Magics. Yeah? And they all target different types of small businesses and provide different types of loans. Some other financial institutions includes AIM, Amanah Ikhtiar, the Ministry of Women's, Families and Community Development, SME Corp, as well as SME Bank. Well, that wraps up the topics on financials aspects of small businesses. So we've covered what are the 4 main objectives, which is identifying how the financial institution selects and determine the right type of small businesses, but it doesn't stop there. These parameters may change in the futures, but the basics are there. So I hope that all the students understands what required by the financial institutions for small businesses to operate and how to manage the financial of the small businesses. Till that, I thank you.